The conflict between Iran and the United States did not begin with a single missile strike. Its origins stretch back to 1953, when American and British intelligence helped remove Iranian Prime Minister Mohammad Mossadegh after he nationalized the country's oil industry. Washington then supported Shah Mohammad Reza Pahlavi until Iran's 1979 Islamic Revolution overthrew the monarchy and transformed the United States from an ally into Iran's principal adversary. The seizure of the American embassy in Tehran, years of sanctions, Iran's nuclear program, and the expansion of Iranian-backed armed groups across Iraq, Lebanon, Syria, and Yemen steadily deepened the confrontation. Tensions intensified further after the United States withdrew from the nuclear agreement in 2018 and killed Iranian commander Qasem Soleimani in 2020. The decisive escalation came in 2026 when a United States-Israeli offensive targeted Iranian nuclear and missile facilities. Iran retaliated against American bases, regional allies, and commercial shipping, while Washington launched repeated strikes on Iranian military infrastructure. What had existed for decades as a shadow conflict had become a direct military confrontation with consequences extending far beyond the Middle East. The consequences of this conflict extend far beyond the battlefield because the Middle East remains one of the world's most important energy hubs. Nearly one-third of global oil production comes from the region, and much of it passes through the Strait of Hormuz, a narrow waterway between Iran and Oman that serves as the world's most critical oil transit route. On an average day, roughly one-fifth of the world's oil supply and a significant share of global liquefied natural gas shipments travel through this single maritime corridor. Whenever tensions rise, shipping companies, insurers, and energy traders immediately begin pricing in the risk of disruption. Even the possibility of Iran attempting to block or threaten traffic through the Strait of Hormuz is enough to send oil prices sharply higher. As crude oil becomes more expensive, transportation costs increase, airlines pay more for jet fuel, manufacturers face higher production expenses, and electricity prices rise in many countries. Those higher costs eventually reach consumers through rising prices for food, goods, and everyday services, adding fresh inflationary pressure to economies that are still recovering from previous global shocks. Financial markets react just as quickly. Investors typically move money away from riskier assets such as equities and into traditional safe havens, including gold, the US dollar, and government bonds. Stock markets often experience increased volatility as uncertainty grows, while energy companies may benefit from higher oil prices, even as sectors such as aviation, logistics, and manufacturing face mounting cost pressures. What begins as a regional military conflict can therefore ripple through supply chains, financial markets, and household budgets across the globe within hours, reminding the world that geopolitical stability and economic stability are more closely connected than ever before. Whether this conflict remains contained or expands further will determine far more than the future of the Middle East. It could shape the direction of the global economy for years to come. If hostilities continue to escalate, energy prices could remain elevated, inflation may become more persistent, and central banks could delay interest rate cuts in an effort to control rising prices. Slower economic growth, weaker consumer spending, and greater market volatility would likely follow, increasing the risk of a broader global slowdown. The effects would not be felt equally. Oil exporting nations could benefit from higher crude prices, while countries heavily dependent on imported energy, including India, Japan, and much of Europe, would face rising import costs and increased pressure on their currencies and trade balances. Industries such as airlines, shipping, chemicals, and manufacturing would see operating expenses climb, while defense contractors, cybersecurity firms, and some energy producers could experience stronger demand as governments increase military and security spending. For investors, periods like these often trigger a flight to safety. Gold has historically attracted demand during geopolitical crises. The US dollar typically strengthens as a global reserve currency, and government bonds become more attractive as investors seek stability. Equity markets, meanwhile, tend to react sharply to every major development, with prices driven as much by uncertainty as by economic fundamentals. History has shown that wars are fought with missiles and armies, but their consequences are measured in oil prices, inflation, interest rates, and financial markets. What began as a decades-long geopolitical rivalry has evolved into a global economic story, one that affects not only governments and investors, but also businesses, supply chains, and households around the world. As long as uncertainty remains, the world's attention will stay fixed not only on the battlefield, but also on the markets that react to every new headline.